Hello and welcome back to What Would Peter Lynch Do? This is where we try and make sense of finance through the lens of, well, a legendary investor.
Glad to be here.
Today is Tuesday, May 20th, 2025. And the market's taken a bit of a turn, hasn't it? Down after that 7-day run-up.
Definitely seeing some reversal. And there's always that chatter, isn't there, about maybe a bit too much confidence creeping in sometimes.
Right, even hearing whispers about, needing to watch out for overconfidence at the top levels.
It certainly makes for an interesting backdrop. A lot of investors probably feeling a bit whiplashed.
Whiplashed, exactly.
Yeah.
Which leads us perfectly into the question we've been getting from quite a few of you. What is the impact of the U.S. Treasury market on the stock market?
The big one. Yeah.
So that's our mission for this deep dive. We want to unpack that, explore it, but specifically through the principles and the wisdom of Peter Lynch.
Okay, yeah. It's a really crucial question, especially, like you said, when the market feels a bit shaky, trying to find solid ground. Let's see how Lynch might guide us through this.
Let's start with just how connected these two markets really are. I saw a really interesting discussion over on the Bogleheads Reddit forum.
Oh, yeah. What were they saying?
Well, the main point was just how, deeply embedded U.S. treasuries are in the whole global financial system. It's not just a U.S. thing.
Absolutely not. They're like a bedrock asset for the whole world, really. So the idea was if that foundation crumbled.
Yeah, the feeling was it would affect pretty much everyone, everywhere. Yeah, widespread consequences.
Right, it's a cornerstone. Any kind of serious default or even just major disruption could set off, well, who knows what kind of chain reaction globally. Very unpredictable.
It was interesting, though. Some people were jumping to full-on Mad Max scenarios, end-of-the-world stuff.
Yeah, you always get some of that.
But a lot of others pushed back, saying, look, a financial crisis doesn't automatically mean total societal collapse. They brought up Japan's Nikkei crash, the Great Depression.
Mm-hmm. Important examples.
Life went on, it's incredibly tough, huge economic hardship, definitely. But not like the zombie apocalypse.
That's a really key distinction, isn't it? Financial meltdowns have real painful impacts, jobs, savings, everything. But history shows societies tend to endure even if they get a lot poorer for a while. Those folks on Reddit sharing experiences really drive that home.
And they got into hedging too, the usual suspects. Gold, maybe diversifying internationally.
Sure, the classic hedges.
But even there, people pointed out it's not simple. Gold can be volatile itself, and holding it costs money.
Exactly. And going international, well, you swap U.S. risks for currency risks, political risks elsewhere. It's complex. There are always trade-offs.
But boiling it down, the real nerve jangler from that thread seemed to be the possibility of a U.S. default, like a real one.
Yeah, that's the nightmare scenario for many.
The worry being, if the U.S. can't or won't pay its debts, then is anything truly safe? Could it just pull everything down with it, all asset classes?
That's the fear. It would be such a massive shock to confidence worldwide. Investment could just freeze up, asset values plummeting.
Yeah.
It's not pretty to think about.
And someone even brought up that article, The Not-So-Secret History of U.S. Defaults.
Right, reminding people that while it's rare and historically they've been sort of technical or minor, it has happened.
Exactly. They were resolved quickly, relatively small scale, but the fact that there's any precedent at all, I think that just fuels the anxiety a bit now.
Understandably so. Okay, so with that context, maybe let's pivot to Lynch himself. How did he see bonds compared to stocks? I know he had some pretty direct thoughts in his book.
Oh yeah, super direct. He basically said, and I'm quoting here from the PDF, you'll never get a 10-bagger in bonds.
Classic Lynch, straight to the point. That really sums up his belief in stocks for growth, doesn't it?
Totally. His logic was, if you buy a bond, you don't get to participate in the company's growth. Stocks give you that ownership, that upside. Bonds just give you the coupon payment, basically.
You get your money back, plus interest, hopefully, but none of the potential explosion in value that a great company can deliver.
And he also noticed something else, that the bond market itself had changed. He said it had become much more volatile.
He did. What was his take on that?
He said, it's become as volatile and hard to predict as the stock market. Almost like trading bonds was becoming like trading stocks.
That's a really sharp observation, because the old view was bonds, safe and steady. He saw that changing, that they were getting riskier, more unpredictable.
Yeah, which probably reinforced his preference for stocks, I imagine.
Makes sense. And it all comes back to his core idea, right? Invest in the company, the business itself, not just paper assets or trying to play the market swings.
Okay, so let's add another layer here. There's this analysis from ATFX about treasury yields. They were saying, back when it was written in 2021 anyway, that rising yields were becoming a big deal, causing volatility.
Right, yields are always a key indicator. They reflect the cost of borrowing for the government and kind of set the baseline for other interest rates.
And the expectation then, because the economy looked like it was recovering strongly, was that the 10-year treasury yield would likely keep climbing.
Which can have knock-on effects. Higher yields can make newly issued bonds look more attractive compared to stocks, potentially pulling some money away.
Does it always mean stocks go down, though?
Not necessarily a direct one-to-one, but it can make things harder for stocks. Higher borrowing costs for companies, for example, could squeeze profits. It can dampen sentiment. The ATFX piece didn't spell out a specific negative link, but it highlighted the rising yields as a source of market jitters.
Okay, so let's try and synthesize this. We have the interconnectedness, the default worries, Lynch's preference for stocks and dislike of bonds, and the impact of yields. How would Peter Lynch likely look at all this noise from the treasury market when deciding about his stocks?
Well, knowing Lynch, his focus would almost certainly remain on the individual companies.
Right. He had that quote, didn't he? Something like, "Nobody can predict the future, but we act like we can."
Exactly. He was deeply skeptical of trying to time the market based on macroeconomic forecasts, whether it's predicting interest rates or recessions or anything else.
So would he be advising people to sell stocks just because treasury yields are going up or down?
Highly unlikely. His mantra was, ignore short-term fluctuations. That kind of reaction, selling good companies because of bond market moves, seems like the exact opposite of his philosophy. It's market timing, essentially.
Which sounds a lot like that stay the course idea you hear from the Bogleheads community too, even with these big worries floating around about treasuries.
Precisely. Find a sound strategy based on your goals and risk tolerance, and stick with it. Don't let the day-to-day or even month-to-month noise, whether from treasuries or anywhere else, knock you off track.
Because his fundamental advice never really changed, did it? It was always invest in companies, not in the stock market.
That's the core. Focus on whether the business you own is doing well, if its prospects still look good. Are earnings growing? Is management competent? That's what matters long-term, not whether the 10-year yield ticked up a quarter point this week.
It ties into his whole advantages of dumb money thing too,
Yeah.
right? Like everyday people can understand McDonald's or Home Depot.
Yes, understand the businesses you encounter in your daily life. Analyze those. That's where your edge is, according to Lynch, not in trying to outguess PhD economists on where treasury yields are headed next month or next year.
And just to hammer home the point on market timing, he was crystal clear on that. He said, obviously, you don't have to be able to predict the stock market to make money in stocks.
Couldn't be clearer. He saw it as a trap. People get swept up in the excitement, the FOMO, when things are rising, so they buy high.
And then when things inevitably dip, or there's scary news like potential treasury instability,
Panic sets in. Fear takes over. They sell low to cut their losses, or just to make the anxiety stop. And the result, as he put it, is that individual investors always end up buying high and selling low, losing money.
so these treasury concerns, however valid they might feel, could just be another trigger for that destructive cycle.
They absolutely could be. Which brings us back to his grounding principle. Stand by your stocks as long as the fundamental story of the company hasn't changed.
So unless the treasury market movements are somehow fundamentally altering the long-term prospects of your specific company,
Then reacting emotionally is likely a mistake. The fluctuation itself isn't the signal to sell a good business. Focus on the business story.
okay, that feels like a good place to land. So for today's Peter Lynch takeaway, let's go with that key quote: ignore short-term fluctuations.
Simple, but powerful. And hard to do sometimes.
Definitely hard to do, but maybe try and keep that phrase in mind as you navigate, well, whatever the market throws at us next.
It's good advice. And you know, it's not just for investing, is it? That principle, focusing on the long-term fundamentals, the important stuff, not getting thrown off by every little bit of daily noise or anxiety, that's pretty solid life advice too.
That's a great point, focusing on what really matters in the long run.
Avoid the emotional roller coaster.
Well said. All right, that wraps up our deep dive for today here on What Would Peter Lynch Do?
Always good to talk through this stuff.
Thanks so much for joining us, and thank you for listening. We hope you have a great day, and we'll catch you next time.